Coinsurance is one of the most confusing insurance terms because it can mean different things depending on the policy. In health insurance, it usually means the percentage of covered costs you pay after meeting the deductible. In property insurance, it can mean a rule requiring you to insure the property for enough of its value. Same word, different mechanics. Start with health insurance. Suppose your policy has a deductible and then 20% coinsurance. If you have not met the deductible, you may pay the allowed cost until the deductible is reached. After that, the insurer pays part of covered services and you pay the coinsurance share. A $10,000 covered bill might leave you responsible for 20%, depending on plan rules. Coinsurance is different from a copay. A copay is usually a fixed amount, such as $30 for a visit. Coinsurance is a percentage, so the amount changes with the size of the bill. 20% of a small lab test may be manageable. 20% of a surgery can be a serious expense before the out-of-pocket maximum protects you. The allowed amount matters. Health insurance does not always calculate coinsurance from the sticker price a hospital originally charges. Plans often use a negotiated or allowed amount for in-network care. If the hospital charges $12,000 but the allowed amount is $8,000, coinsurance may be based on the $8,000, not the original sticker price. Networks can change the result. In-network coinsurance may be lower because the insurer has negotiated rates. Out-of-network care may have higher coinsurance, separate deductibles, or less protection. A patient may think 20% is always 20%, but the base price and network rules can make the real bill very different. The out-of-pocket maximum is important because coinsurance can otherwise feel open-ended. In many health plans, once you reach the yearly maximum for covered in-network services, the insurer pays covered costs for the rest of the year. This does not mean every possible bill disappears. Non-covered care, out-of-network charges, or excluded services may still create costs. Here is a simple health example. A person has a $1,000 deductible, 20% coinsurance, and a $5,000 out-of-pocket maximum. A covered procedure has an allowed cost of $6,000. The person pays the first $1,000 as deductible. The remaining $5,000 is shared, so 20% is another $1,000. The total patient cost is $2,000, assuming no other rules apply. Now compare that to property insurance. Property coinsurance is not about splitting every claim by a percentage after a deductible. It is often a penalty rule. The policy may require the owner to insure the building for a certain percentage of its replacement value, such as 80%. If the owner carries too little insurance, a claim payout may be reduced. Imagine a building would cost $500,000 to rebuild. An 80% coinsurance requirement means the owner should carry at least $400,000 in coverage. If the owner only carries $200,000 and then has a partial loss, the insurer may pay only a reduced share. The penalty appears because the property was underinsured before the loss. Property coinsurance exists because insurance pricing depends on the amount at risk. If owners could insure a large building for a small amount and still receive full payment for partial losses, premiums would not reflect the real exposure. The coinsurance clause pushes owners to carry coverage closer to the property a euro's true replacement cost. This is where many people get surprised. A business owner may think, the damage was only $50,000, and my policy limit is $200,000, so I am safe. But if the building should have been insured for $400,000 under the coinsurance requirement, the payout may be reduced even though the loss is smaller than the policy limit. Deductibles still apply separately. In a property claim, the insurer may first calculate the coinsurance penalty, then subtract the deductible, depending on policy language. That order matters. A landlord, shop owner, or homeowner with a special policy should not guess. The declarations page and coinsurance clause need to be read together. The declarations page usually shows whether coinsurance applies. It may list a percentage, the insured value, and coverage limits. The problem is that many people only look at the premium and deductible. Coinsurance hides in the math. A low premium may come from a low insured value, but that choice can become expensive after a claim. Coinsurance also connects to inflation. If rebuilding costs rise and the policy limit stays the same, a property can become underinsured without the owner noticing. Lumber, labor, permits, and materials can change quickly. An annual coverage review helps make sure the insured value still makes sense, especially for buildings or expensive business property. For health insurance, the practical check is different. Look at deductible, coinsurance percentage, out-of-pocket maximum, network rules, and covered services. A plan with low premiums but high coinsurance can be risky for someone expecting surgery, childbirth, chronic treatment, or specialist care. The cheapest monthly premium is not always the cheapest yearly cost. For property insurance, ask whether the coverage limit is close to replacement cost, not just market value. Market value includes land, location, and buyer demand. Replacement cost focuses on rebuilding the structure. A building may sell for one number and cost another number to rebuild. Coinsurance usually cares about the rebuild exposure. Coinsurance is not automatically bad. It is a cost-sharing or coverage discipline tool. In health insurance, it shares covered expenses between patient and insurer. In property insurance, it discourages underinsurance. The danger comes from misunderstanding which version applies and how the math works before a bill or claim arrives. A major mistake is comparing plans only by the coinsurance percentage. 10% sounds better than 20%, but the premium, deductible, network, allowed amounts, and out-of-pocket maximum may change the final cost. A plan with lower coinsurance can still cost more over a year if the monthly premium is much higher and the person rarely uses care. For property owners, the mistake is assuming the purchase price is the same as the rebuilding cost. Land can make market price high, while an old structure may cost less to rebuild. In another area, rebuilding may cost more than market value because labor and materials are expensive. Coinsurance calculations usually care about replacement exposure, not the emotion of the sale price. The safest habit is to ask for a sample claim calculation before relying on a policy. A health plan example can show what happens after the deductible. A property example can show what happens if the insured value is too low. One realistic calculation often explains coinsurance better than a page of definitions. The simplest way to handle coinsurance is to read the policy with one question in mind. What number will I owe or lose if something happens? For health coverage, that means calculating possible medical bills. For property coverage, that means checking insured value against replacement cost. Coinsurance is confusing until the math is made visible. Once visible, it becomes a number you can plan around. Once you know that share, you can compare policies by real possible cost, not only by the premium that looks cheapest.